Hello friends, in this unit we are going to discuss about another financial services, that is mutual funds. So how the mutual funds are defined or described, as if we see as per SEBI, your mutual funds are funds which are established in the form of a trust to raise money through the sale of units to the public under various schemes for investing in securities including money market instruments, equities or gold related instruments or real estate assets. So basically a mutual fund pools the savings particularly of the relatively small investors and invest them in a well diversified portfolio of sound investment. It issues units of securities to unit holders or investors according to the amount of money invested by them. The profits or losses are shared by the unit holders in proportion of their investment in the mutual fund schemes. A mutual fund is set in the form of trust. Which has a sponsor, trustee, and asset management company and custodians. The sponsors set up the trust as promoters. The trustee hold the property in trust for the benefit of unit holders. They are vested with the general powers of superintendence and direction over the asset management companies, and they monitor their performance and complies with the SEBI regulations. The asset management company manages the fund. The custodian holds the securities of the fund in its custody. As an investment intermediary, mutual funds offer a variety of services or benefits to the investors, such as convenience, low risk through diversification, expert management, and lower cost due to economies of scale, which will be discussed further in detail. So, next thing which we are going to discuss about the different schemes or different types of mutual funds which are available in the market to the investors. So first thing is that your mutual funds can be classified on the basis of organization structure. That is your structure of the mutual fund schemes. They can be classified into open-ended schemes, closed-ended schemes, interval schemes. Open-ended schemes are perpetual and open for subscription and repurchase on a continuous basis on all business days at the current net asset value. Whereas closed-ended schemes have a fixed maturity date. The units are issued at the time of the initial offer and redeemed only on maturity. The units of closed-ended schemes are mandatorily listed to provide exit route before maturity and can be sold or traded on the stock exchange. Whereas in case of interval schemes, it allows purchase and redemption during specified transaction periods or intervals. The transaction period has to be for the minimum of 2 days, or there should be at least a 15-day gap between two transaction periods. The units of interval schemes are also mandatorily listed on the stock exchange. Another classification of another classification of mutual funds can be done on the basis of portfolio management. That is your active funds and passive funds. In case of active fund, the fund manager is active in deciding whether to buy, hold or sell the underlying securities and in the selection of stock. Active funds adopt different strategies and styles to create and manage the portfolio. The investment strategy and style are described upfront in the scheme information document. Active funds expect to generate better returns than the benchmark index. The risk and return in these funds will depend upon the strategy adopted by the fund house. Active funds implement strategies to select the stocks for the portfolio. Whereas in case of passive funds, it holds a portfolio that replicates a stated index or benchmark index, like ETFs, exchange traded funds or index funds. In a passive fund, the fund manager has a passive role, as the stock selection, buying, holding, sell decision is driven by the benchmark index, and the fund manager or dealer merely needs to replicate the same with minimal tracking error. So basically we can say that active funds rely on professional fund managers who manage these investments, and Its aim is to outperform benchmark index, and it is suited for investors who wish to take advantage of fund managers' potential. Whereas passive funds, in case of passive funds, investment holdings mirror and closely track a benchmark index. That is your ETFs or index funds. It is suited for the investors who wanted to allocate exactly their funds as per the market index. And in this case, there is lower expense ratio, hence lower cost to investors, and there is better liquidity in case of such funds. So next classification of mutual funds can be done on the basis of investment objectives. Thus, it can be classified into various aspects such as growth funds, income funds, or liquid, overnight, or money market mutual funds. Growth funds are basically schemes that are designed to provide capital appreciation. Such schemes primarily invest in growth-oriented assets such as equity. Investment in growth-oriented funds require medium to long-term investment horizon. Historically, equity as an asset class has outperformed most other kind of investments held over the long term. However, returns from the growth funds tends to be volatile over a short term, since the prices of underlying equity shares may change, hence investors may be able to take volatility in the returns in the short term. Another type of funds are income funds. The basic objective of these funds is to provide regular and steady income to investors. Income funds invest in fixed income securities such as debentures, corporate bonds, or government securities. The fund return is from the interest income earned on these investments as well as capital gains from any change in the value of the securities. The fund will distribute the income provided the portfolio generates the required returns. There is no guarantee of income. The return will depend upon the tenure and credit quality of the securities held by the mutual fund organizations. Next type of mutual fund on the basis of investment objectives are liquid, overnight, or money market mutual funds. Liquid funds, overnight funds, money market mutual funds are investment options for investors seeking liquidity and principal protection with commensurate returns. The funds invest in money markets with maturity not exceeding 91 days. The returns from the funds will depend upon the short-term interest rate prevalent in the market. These are ideal for investors who wish to park their surplus funds for short periods. Investors who use these funds for longer holding periods may be sacrificing better returns possible from products suitable for a longer holding period. Another classification of mutual funds can be done on the basis of investment portfolio. So mutual fund products can be classified based on their underlying portfolio composition. That is, first level of categorization can be on the basis of asset class the funds invest in, such as equity, debt, money market instruments, or gold. The second level of categorization can be on the basis of strategies and styles used to create such portfolios, such as income fund, dynamic bond fund, infrastructure fund, large mid-cap, small mid-cap funds, equity funds, value funds, etc. The portfolio composition flows out of the investment objectives of the scheme. This was all about the types of different mutual fund schemes available, different mutual funds classification on the basis of various aspects. So further coming to the benefits of investing in mutual funds, there are numerous benefits available to the investors when they invest in mutual fund schemes. First benefit we can discuss of is professional management. Since any person who is investing for mutual funds may not have the time or required knowledge of the resources to conduct their research and purchase individual stocks or bonds. So basically, a mutual fund is managed by full-time professional managers who have the expertise, experience, and resources to actively buy, sell, and monitor these investments. So a fund manager continuously monitors investment and rebalances the portfolio according to meet the scheme objectives. So portfolio management by professional fund manager is one of the most important advantages of the mutual fund schemes. Another advantage of mutual funds, of investing in mutual fund, is risk diversification. Buying shares in mutual fund is an easy way to diversify your investment across many securities and asset categories such as equity, debt, gold, which helps in spreading the risk. So thus, it proves to be a beneficial investing scheme when an underlying security of a given mutual fund scheme experiences market headwinds. With diversification, the risk associated with one asset class is countered by the others. Even if one investment in the portfolio decreases in value, other investment may not be impacted and may even increase in value. So you don't lose out the entire value of investment in case if your particular component of your portfolio goes through a turbulent period. Thus, risk diversification is one of the prominent advantages of investing in mutual funds. Another benefits that mutual funds provides the investors is affordability and convenience. Since it could be more costly to direct purchase all of the individual securities held by a single mutual fund. Therefore, by contrast, if we see mutual funds enables the minimum initial investments for investors, and thus making it affordable and convenience for the investors. Another benefit which mutual funds provides is liquidity. Mutual fund schemes enables you to easily redeem units of open-ended mutual fund schemes to meet your financial needs on any business day. So, upon redemption, the redemption amount is credited to the account of the investor within 1 day to 3-4 days, depending upon the type of scheme the investor have invested in. For example, in respect of liquid funds and overnight funds, the redemption amount is paid out the next business day. However, your units of closed-ended mutual fund schemes can be redeemed only on the maturity of that particular scheme. Likewise, units of equity-linked schemes have a 3-year lock-in period and can be liquidated only thereafter. Further, it also provides low cost, since due to huge economies of scale, mutual fund schemes have a low expense ratio, and expense ratio represents basically what is an expense. Before, how your mutual fund schemes provides you a low cost, it's necessary to understand the expense ratio. So expense ratio represents the annual fund operating expenses of a scheme expressed as a percentage of fund daily net assets. So operating expenses of the scheme are administration expenses, management expenses, advertising related expenses, etc. The limits of expense ratio for various types of schemes has been specified under Regulation 52 of the SEBI Mutual Fund Regulation 1996. And since the mutual fund organizations operates on a huge level, therefore due to economies of scale, they have a lower expense ratio, which results in low cost for the investors. Another aspect or benefit that mutual fund provides is that they are regulated by the capital markets regulator, and that is your Securities and Exchange Board of India under SEBI Mutual Fund Regulations 1996. So SEBI has basically laid stringent rules and regulations keeping investor protection, transparency with appropriate risk mitigation framework and fair valuation principles. Another benefit you get while investing in mutual fund is that tax benefits. When you invest in your equity linked savings schemes, then you can up to the investment of 1 lakh rupees 1,50,000, you can take in tax benefit on that amount under section 80C of the Income Tax Act 1961. Therefore, mutual fund investments when held for a longer term are tax efficient for the investors. Other than advantages of investing in mutual funds, there are certain disadvantages also for investors while investing in mutual funds. So let us discuss one by one. So first disadvantage of mutual funds of investing in mutual fund is lock-in period. Some of your investments, such as your closed-ended schemes, have an 3-year lock-in period, which means that you won't be able to redeem your money until that lock-in period expires. On the other hand, some of the funds are such in which you stay invested for a year. If you still want to leave a fund before the lock-in period, you have to pay a certain fee known as exit load fee. Another thing is that in case of mutual funds, there might be fluctuating returns. Since mutual fund schemes do not promise fixed returns, therefore, in case of worst case scenario, which includes depreciation in the value of the mutual funds or any turbulent times, that might be the case that mutual funds may subject to wide range of price changes. Thus, or thus this professional fund management does not protect you from the poor fund performance which might occur due to certain reasons existing in the market. Another disadvantage is that you don't have control over, there is no control over the funds. Fund managers oversee all forms of mutual funds. A team of analysts may assess the fund management in several circumstances. As a result, you have no influence over your money as an investor. Your fund manager makes all significant decisions regarding your fund. However, you look at the certain essential parameters like disclosure norms, corpus, and so on. That's all. In case of your control on the mutual fund schemes, otherwise your funds are basically managed by your portfolio managers. So another disadvantage of mutual fund is compounded annualized growth rate. That does not provide investors with enough information about the level of risk a mutual fund involves or the investment procedure involves. Since compounded annualized growth rate is only one of the metrics which is used to assess a fund performance, thus it is far from comprehensive and thus it does not give any investor enough information to conduct the proper analysis of that particular mutual fund scheme. Another disadvantage is fund evaluation. For many investors, conducting comprehensive research and evaluating the worth of several funds might be tough. The net asset value of a mutual fund tells investors how much the fund's portfolio is worth. However, investors must examine a variety of indicators to determine how one fund can perform compared to another funds, which can be time consuming. Further, there might be unpredictable tax outcomes in case of mutual funds. So investors who invest in mutual funds do not have to bother constantly about buying and selling shares. As a result, average investor will have to put in less efforts. Investor may get year-end dividends if a mutual fund sells securities from its portfolio. These are taxable investment distributions. Depending on how long an investment is held, these distributions are taxed at ordinary income or capital gain rates, which means you may end up with a higher than expected tax bill at the end of the year. Those who live in high tax states should pay extra attention to this because it can chip away their gains or the benefits the investors are having. So coming to the differences, now the last topic which we are going to discuss under this unit is difference between mutual funds and hedge funds. A mutual fund is an investment vehicle whereby the funds are consolidated from several investors and managed by a professional fund manager for purchasing basket securities from the stock market. On the other hand, hedge funds are portfolio of investments whereby only a few established investors are permitted to contribute to purchasing assets. The objective of mutual fund is to offer returns over the market risk-free rate of return, whereas in case of hedge funds, the aim is to offer maximum possible returns from the investments made. In case of mutual funds, the investors are retail investors who divert their limited disposable income into these funds with the hope of growing their money. Whereas in case of hedge funds, the investors are high net worth individuals or institutions or established individuals with a large appetite for risk. These investors make very large investments and desire very high returns in a quick time. Another thing is that a professional fund manager manages both type of funds, both, but a mutual fund manager does not hold a substantial interest in the fund's working. Hedge fund managers have a mandate to hold a large share in the respective fund to generate a level playing field on the part of the manager and prevent any decisions that can be detrimental to the overall interest of the fund. Mutual funds are tightly regulated by SEBI, which is not an important criteria or essential in case of hedge funds. Hedge funds offer information only to investors without any public disclosure of the information. Whereas in case of mutual fund organizations are required to completely adhere to the yearly publishing of annual reports or balance sheets and quarterly performance of their assets under their mutual fund schemes. These disclosures must be made public with the statement sent to all the investors stating the overall performance. The management fees for mutual funds depend on the percentage of assets managed, whereas for hedge funds the fees are based on the performance of the assets. Numerically, mutual funds have a large number of investors, with each having a limited investment. In contrast, hedge funds have a small number of very large investments by each investor. The redemption of mutual fund is relatively easier to execute since the amount of funds is relatively less. Whereas in case of hedge funds, the lock-in period is a long time, due to which redemption is not possible. Subsequently, redemptions are made in blocks and 100% amount cannot be redeemed. This was all about mutual fund services. Thank you.